Okay, Kate, do you have another speaker for me?
Yeah, we've got Eric Gebhard.
Hey, Eric, how's it going?
Hi, how you doing? Good to hear from you, John. Good to hear from you, Kate.
Where are you broadcasting from today?
Well, I would like to be uh skiing somewhere, but there's no snow around us, so I'm at home in Orange County in my home office.
Orange County, California.
Yep, yep.
Okay, they just had a giant earthquake up in Eureka.
No,
You-
I didn't know that.
Yeah, 7.0. It's just hit the headlines.
Oh, that is big.
That is a big one. So we'll probably have the pictures come through in the next few minutes. Go ahead and get your PowerPoint up. After several years, AltaVest developed a large client base of option traders. The AltaVest team saw a need to make complex option spreads simple. They then developed the ThetaTrader, which pre-selects complex multi-leg option trades on stock indexes and automatically manages risk and reward. The ThetaTrader technology allowed for the creation of a unique six-legged options spread structure called the Dragonfly. ThetaTrader also utilizes an integrated trade alert functionality wherein to respond to an alert, the client only needs to touch accept or reject on their smart device. Mr. Gebhardt also worked to make automated futures trading system available to AltaVest clients via user-friendly platform called AV Systems. The purely algorithmic driven systems on AV Systems platform, as well as unique option strategies offer non-correlated investment opportunities. Mr. Gebhardt enjoys spending time with family on adventurous outings, along with vintage automobiles, bike riding, and church activities. He also volunteers as a member of the Dean's Advisory Council for La Sierra University's Zapara School of Business. Okay, Eric, you know the drill. You've done this before. You have until 5 minutes before the hour, and then I'm going to go ahead and hand out the last batch of prizes for today.
All right, sounds good. Well, let's get started here, folks. We got a lot of material, and we're going to look at automated stock index options trading and also our unique trade alert functionality. And with that said, let me jump into the risk disclosure here before we get started. Remember, we are speculating, and that means we're trying to make money and profit, but there is always risk when there is the possibility of reward. So do take a moment and look at that risk disclosure, and it's probably better to take a screenshot or take an image of that if you want to read through every detail. But the main thing to know here is past performance is never a guarantee of future results, and you should only be using risk capital when trading. A little bit about AltaVest. Since 1997, we've been a registered introducing brokerage firm, and we've traded millions of contracts along the way. That's some of us down on the trading floor of the S&P 500 options trading pit in Chicago, some of our floor brokers there. But it doesn't look like that anymore. Not a lot of activity with people on the floor. Everything is electronic. We're going to talk a bit about that. We created the Dragonfly strategy as well as our proprietary order execution technology. And again, clients have been trading with us for decades, millions of contracts along the way using our solutions. We're registered with the CFTC and a member of the NFA, and we're located in California. A little bit about myself. I co-founded AltaVest. I was licensed back in 1991, graduated from University of Southern California with my BS in Business Administration. I had my Series 6 and 63 securities licenses. Currently have my Series 3 commodity futures and Series 65 investment advisor license as well. So with the introduction out of the way, we'll get into some of the meat and potatoes here. Algorithmic trading is 90% of the stock market, according to JP Morgan. So 90% of US equity trading volume. So here's what your competition really looks like, folks. Kind of like the Terminator, a machine, relentless, no emotion, automation, built-in risk and reward controls, and really designed to run over us. But can we use professional option strategies to compete in this environment? And the answer is yes. So remember, Wall Street uses options spreads. This woman here, I'm going to refer to her later on. You'll see the link on how to watch her presentation. But she mentions here an option spread is the buying and selling of different contracts. It's a very common way for investors to hedge risk and volatility. It's usually cheaper because you can offset your cost by the proceeds from different contracts. And it's been used by Wall Street professionals for decades. So she's absolutely correct. And what about trading options like a large institution might? Well, let's look at an insurance company. We understand how they make money because we're always paying them premiums. And you pay them to assume the risk that you don't want. And they essentially sell and manage time is really what they're doing, and risk. And they insure themselves by reinsurance, they call it, or hedging. They're consistent and they're patient in their process, and they look at math, probabilities, favorable odds, long-term odds, statistics, actuarials, that type of thing. They use a lot of quantitative and data-driven processes. So they're looking to put the odds in their favor, and we want the odds to be in our favor when we're trading. So we'd like to talk a little bit about premium collection when we're trading options. You want to be able to manage risk and reward and not get too greedy. You need some help along the way with experienced coaching. We can use some automation to make this more palatable for us because, as you know, it can be a very complicated endeavor. And we're looking for base hits along the way. We're not necessarily swinging for the grand slams. And these short option strategies or premium collection can be for any market condition, and you're targeting outcomes in advance with fixed risk and reward. Before we jump into the demo, we're going to look at 2 of the letters of the Greek alphabet, and we're going to look at how probabilities are referred to when we're talking about options. The first is delta, and that references how much does the option value change with a change in the underlying index or asset. But it's also used by traders as the approximate probability of expiring in the money. And that's how we're going to look at delta. So for example, if delta is 0.25, that means there's a 25% chance that option expires in the money. But conversely, 75% chance it would expire worthless. Remember, of course, delta is always moving up and down moment by moment with the price change of the asset as well as time. And of course, delta is not the probability of a winning trade. So you don't want to conflate those 2 definitions there. The other letter we're going to look at is theta, and that's a sensitivity to time is what that really references when you're speaking of options. Every option has limited life. Everything expires at some point because of time decay. So theta is a negative number. It equals 1 day of time decay. So if an option is at 10 points, the theta is negative 0.05 in this example. And then all things remaining equal, the premium would drop to 9.95. Then after that, drop down to 9.90, and so on and so forth. And here's what that looks like on a graph. As you can see along the timeline here, as you approach time 0, the percent of the premium remaining drops and drops and drops and drops simply because the sands of time are running out on the lifespan of that option. All right. Oh, here we go. So let's look at an example of a spread. And here's an E-mini S&P 500 call spread, and we're going to sell that spread. So you can do this if you're bearish or even moderately bullish, or if you have really an idea that markets are going to be choppy. And we'll talk a bit about why we're looking at the E-mini S&P 500. We'll talk about that a little bit later. So here's what it looks like on a graph. Here's the S&P 500 moving along here, going down, going up. And here's a call spread, for example, that could have been sold. The red line is the call that you sell, and you collect 4.5 points for selling that call. The blue line is the call that you simultaneously buy. So you do this as one order, and you pay 2.25 points as a hedge. So the net result is you collect 2.25 or $112.50 in this example, minus your commission. And that's going to work well if, in this case, you see the market sort of went sideways, went lower, went a little higher, but eventually didn't come anywhere near the red line there, which is the short call. And here's an example of selling a put spread. So you can do this in just kind of the opposite environment. If you're bullish, moderately bearish, or non-directional. And again, just the flip side of what we looked at. The red line is the put that you sell. The blue line is the put you buy. You can do this simultaneously as one order, and the net result is you collect 2 points or $100 minus your commission. And you can see in this example, even though the market moved lower here, eventually kind of chopped around and went back up, and then you would have been able to close out that position and probably do quite well on that in that example. We'll look at some other examples where the trades don't always work out, but these are just to illustrate the concept of these trades. And here's an iron condor. It's kind of an odd name. It's kind of, I think it refers to the graph when you graph out the risk and profit on the graph and the way the graph kind of portrays the wings of a condor. But anyway, it's a combination of the put and the call spread. It's a non-directional strategy. So you sell this out of the money call spread and you sell the out of the money put spread. You do it simultaneously. So you have 4 different options involved in this one trade. You can see the example here with the different strikes. So the idea is you collect the net premium on the call spread and the put spread, and you can see you look for the market to kind of chop around and go sideways over a period of time. You can see the expiration date here on this particular trade. And these spreads are covered, of course. These are not naked options. So every short option, there's a long option. So this is what happens in an example, because time decay works its magic. And on that one example we just looked at, you can see this arrow here. This is where you would buy back the spread. So you initially sell it, collect the premium, and then you buy it back later for less money than what you received. And you can see the blue arrow here pointing to this here called the RTI, and I'll explain that in the demo. But these are the signals that the ThetaTrader software will give you, and you can have all of this automated as well. And here's a dragonfly. So it has 6 legs. It's another non-directional strategy, and it's really a variation on the condor. And here's what it looks like. And don't let it overwhelm you, but we'll show you how we can simplify this. But you have 4 calls that you sell. You buy 3 further out of the money calls, and then 1 closer to the money call. And then you sell 4 puts, and you buy 3 puts further out of the money, and then you buy 1 additional put closer to the money. So the same structure on the calls and the puts here. And the idea, again, you collect net premium on the puts and the calls. You'll notice the call here that you buy, the 56.25 strike, is 50 points closer to the money than the 4 that you sold. And in this case here, the puts have that same relationship as well. And you'll notice that when I look at the demo, it's not always the same. Sometimes it's 50 points, sometimes it's 25, sometimes 75. But ultimately what happens is as the clock ticks and theta decay works, you can see in this example, you sold the spread and the market started moving around. And then at this point here, you get a signal to buy the spread back and cover the trade and take your gains and move on. So you've sold it and then you buy it back for less than what you initially received. And you see the signal right there, that blue RTI. So stick around here, folks. We're going to look at the demo in just a second, but also we're going to look at how to respond to a live trade alert. So we had a couple trade alerts earlier today. So I've left them here in the demo account so we can respond to that in one touch. You simply touch accept on your smart device, and these alerts are integrated with your trading account. So here's the question you probably have is, how would you even know where to begin, which market to choose, which strategy to apply, what's the correct price? In other words, what's your entry timing? And then again, once you have the trade, what do you do with it? That's really probably more important than anything. How do you manage the risk and the reward? And our solution is ThetaTrader. These are pre-built option spreads. Our proprietary algorithm will create what we call theta trades. These are available every day. And then, of course, I mentioned the one-touch responsive trade alerts. Those are integrated and interactive with your trading account. Any market condition, there are strategies available for, and then we use the automation with the RTI. It's called the risk thermal indicator, and that's the color coding that will automatically close out a trade for you when it reaches a profit or a risk target, whichever happens first. That's one of our, a couple of our floor traders years ago, filling some orders for us. That's kind of a cool shot. Anyway, so we're going to go ahead and shift gears now. We're going to switch screens, so bear with me. I do see some comments coming in, so keep comments, questions in the chat and what have you. I'll get to those a little bit later, but we're going to jump into the demo right now. Okay, so now you are looking at the dashboard for ThetaTrader. Very simple homepage or dashboard here, and you'll see the active trade alerts that show up on your dashboard as well as your smart device and email. And then these are the active theta trades for today. And you can see there are bullish strategies, bearish and non-directional. These are all pre-populated. And these are the markets that we're looking at. The E-mini S&P 500, and this is gold, and I'll skip that for now. And this is the mini NASDAQ 100 and the Russell 2000. And these are all the E-mini family of markets. And if you're asking yourself why only those three, well, in a nutshell, that's where all the volume and liquidity and depth of market is to allow these types of complex six-legged spreads to be actually executed. And we'll show you a few more details on that in a bit. But you'll notice open short positions down here. So this is a demo account I have for these sorts of presentations that I'll do at least weekly. So this is just kind of the results from the demo account. You can see these are all green, which means good. A little yellow means a slightly elevated risk, but do nothing. Anywhere from 16 to 58 days left on these open short positions. And these are long open bot positions here. You can see here as well. And we'll explain all the different colors. And then over here would be your account information. And this is pulled directly from your AltaVest trading account. So ThetaTrader is integrated with your trading account and then any current price quotes right here. So why don't we start off by looking at some of these non-directional strategies on the S&P 500 mini. Here's a condor, and you'll see you have, well, before I do that, you'll see you have anywhere from 16 days to 44 days till expiration with these particular condors that the algorithm has generated. It's chosen the strike prices and the various expirations. And you'll notice here, this is called your maximum profit potential on that trade for one lot. And this is your targeted annualized return. And that's really here to compare one trade to another. It's not realistic to expect to place this same trade every 16 days and get 169% return. So that's really to compare one trade to another. And I always like to just pick the one with the most days till expiration. And we're going to dig into the table here, or the graph. And before we do, here's what this looks like. Here's where we're currently trading. Here's the call spread you'll sell, the put spread you'll sell. And the idea here is you look for the subsequent movement to sort of really stay within this range. You see the purple line is the expiration date. So that's what it looks like on the graph, kind of the helicopter view. And here's all the details. I won't go into every single one, but you've got dates till expiration, expiration date, settlement value, the premium, call risk, put risk, your commission, cash required, profit potential, targeted return on cash, and then again, the targeted annualized return. And all these are explained in the glossary as well. And I'll also point out that everything here is net of commissions and trading costs. So everything is all taken into account already with your dollars and percentages. But let's look at here. It's selling the 57.30 put. The algorithm has chosen that strike price. The delta is 9.8. So that means you have an over 90% probability that the put that is being sold to someone else will expire out of the money. And then look at the call here, 6.75 delta. So you're looking over 93% probability that this call will expire out of the money to whoever buys it. So that's why you kind of look at these higher probability outcomes, or at least the algo does. It looks for these opportunities and builds the trade for you. And then here's the put and the call that you buy to hedge or to cover that position. And you'll notice cash required just over $900, and your maximum profit potential is only a little less than 70. So you would think, well, why would I even bother? Well, again, it's because of the deltas here. So you have this opportunity to collect premium, and the algorithm says this has a high opportunity. These options have a high chance of expiring in someone else's hands, is really what the idea is there. And of course, the less time you sell, the lower the value, but you'll notice it defaults here to sell. You're selling that spread, quantity of 1, so we can raise that or lower that as we please, but always defaults to a 1. And you'll see the cash required goes up or down. So why don't we go ahead and do 5 of these, leave the value alone, and we'll place that order. And it's just that simple. Orders filled in the demo account. And why don't we compare the condor we just did to a dragonfly? And then I'll show you a really great feature called the trade simulator. It's sort of a time machine, really. Give it just a second here. And I'm going to pull up today's dragonflies, and I'll show you how that works. Sure, taking its sweet time here. It's funny how that always happens during webinars. I think it has something to do with the third-party webinar software, but could be wrong. If that doesn't, here, I'll refresh this. Why don't we do that? See if that helps. Okay, so we're going to go to the dragonfly here, and you'll have the E-mini S&P 500 and the mini Russell 2000, and the algorithm says there are no NASDAQ dragonflies available for today. And we'll go ahead and, just to be different, we'll do a end of month Russell. In fact, you can see up above here, there's a couple trades, and we're going to get to those in just a bit too. But here's what this trade looks like. So this is the dragonfly. So you can see you're selling 4 calls, buying 3 further out, and then 1 closer to the money, and then the same structure with the puts. And the idea here is you have the market trading here, and then once you place that trade, you hope the market sort of just works within this wide margin of error, and that wide range, or just even go sideways. It could go a little lower, it could go a little higher. And that's the idea with the dragonfly. You have cash required on the dragonfly is higher than a condor because you're selling 4 puts and 4 calls. So each dragonfly, if you did 2 dragonflies, you would sell 8 puts and 8 calls. But you'll see the cash required, 23, 24, your maximum profit potential, targeted return on cash, targeted annualized return there. So we'll go ahead and change that to 2. And again, you notice the strike prices here. The put has a 9.86 delta, the call 7.63 delta. So you have over 90% and 93% probability these puts and calls being sold will expire out of the money. And also you can change the strikes if you'd like, but I wouldn't recommend it. It kind of defeats the purpose of the algorithm doing it for you anyway. We'll go ahead and place 2 of these, and it's just that simple. Now here I want to show under trading, you go to simulator, and this is a really great tool. It's actually very useful and kind of fun to use. But what I've done is I've gone back in time. I picked a few dates to compare and contrast a condor with a dragonfly. And you see this is a trade from October 1st. It's the September end of month, October expiration on the S&P. and you can use these buttons here to see how things would have played out. And you'll notice as time goes by, day by day, the RTI is green. That means good to do nothing with it. You notice the P&L on the trade is slightly negative and then goes green and slightly negative, and that's totally normal because theta decay takes a little bit of time, but now it's turning green and trade's looking good. And then it turns blue. So on October 21st, you get a blue signal, and that means take profits. So you'd be taking profits right here according to ThetaTrader. So you've sold it, collected the premium, and then you cover the trade and you take your profits and move on. And this can be automated. So whenever it turns blue, you don't have to monitor. ThetaTrader is monitoring your account and it will place the order automatically for you. But remember this date here. That's October 21st with 11 days till expiration. And that's the end of month October condor. And let's look at the end of month October dragonfly. So on that same day, instead of doing the condor, you did a dragonfly. Same type of activity, a little red, then it starts getting profitable. And look at this, it turns blue on October 17. So this trade matured compared to October 21st. So it matured several days earlier. So it allowed you to really take your trade off and take your profit and move on to another opportunity. And the reason why is simply because you own this particular call here, and it's so much closer to the money compared to the 4 you sell that if the market's moving higher in this case, it's going to gain in value at a more rapid rate, and that will favor you. And also theta decay doesn't impact it as much because it's closer to the money. So something to keep in mind that the dynamic between a dragonfly and a condor can be totally different, just depending on the situation. Sometimes a dragonfly will mature more quickly than a condor is really the point I'm making here. And here's another condor. Let's see what happens here. So see, it gets yellow, slightly elevated risk. You can see why. It's getting a little bit close to your upper boundary, but still do nothing. Theta decay is starting to work now. Now it's getting even closer, but still yellow, and then it finally turns red. So you end up with a loss on this condor, and that's the July week 2 expiration. And when it turns red, that's too much risk. Get out of the trade, and also that can be automated. So the order's placed for you. So you see that condor ends up as a losing trade. Now, what if you had done a dragonfly on that same day with the same expiration? Let me scroll down. You can see more of the screen here. Turning yellow, slightly elevated risk. And then it turns blue. So you have a profit-taking signal with 15 days till expiration. So again, this option here, you bought it, you own it. So it's actually gaining in value at a more rapid rate compared to the 4 out of the money calls you sold, and that's because it has a higher delta. So it's actually benefiting you in this case, and it ends up turning this condor that was a losing trade, and had you done the dragonfly, looking back in hindsight, that would have been the winning trade. So that's why we like the dragonfly a lot, because it can be more robust, be a little more risk averse, but you will sacrifice some potential gains because you are buying this call and you are buying this put, and that costs money. It's like buying some additional insurance and paying a little extra premium. And here's another example. We'll run through this one. And this here has a profit-taking signal on the condor with 9 days till expiration. And I'm not even sure what happens on this next one. I kind of forgot, but let's take a look. Oh, look, yeah, there we go. This ends up here getting out much earlier with 15 days till expiration on the dragonfly. So again, you see the benefit that the dragonfly can sometimes offer. It's not to say dragonfly will always make money, because of course it doesn't. But compared to the condor, it's more robust, but you do give up some profit potential. And we like to use them both, but we really like to lean into the dragonfly at times. And then here's how you get to the simulator right under here. There's also a trade builder section if you want to start fresh and kind of build your own trades and not use the theta trades. But let me show you under my account. I want to show you what we also offer. We also offer this daily proprietary research called TradeScope. Can help guide your decisions here, looking at some of the technicals and also about kind of what's on the agenda for the next several days and weeks ahead, especially looking at monetary policy, how that seems to influence the markets probably way too much, more than it should. But also we have our daily trading commentary. So you have a review of what's happening in Asia and Europe, and also looking ahead here, and then also some of your economic calendar reports, what's on the calendar. And then here are the settings on how to automate everything. You go under my account to settings, and you'll see right here you can activate the risk manager, checking that box. And then you can also customize it if you like. Right now you saw how when it turns red, you get out of your position. Well, you can change it to an orange risk level, and that gets out of your position a little bit earlier than the red. So your loss is not as large, but you'll take more frequent losses that way. Or you can customize it and you can go down to a 0.25 as well, or not as well, but 0.25 even lower than the 0.38. So that means your losses will be quite a bit smaller compared to the red. However, you'll have more frequent losses. So if that suits you better, you can do that as well. I just leave it at 50. Then here's your profit directive. And then you'll save those settings. So that's how easy it is. And now ThetaTrader is scanning your account and your positions every day. And whenever you have a red or a blue RTI, it automatically submits that order for you. Then we have a great help file, and you'll notice here glossary, and you can read through this. We won't spend time on it, but here's all the color coding. It's all explained on the RTI and how that works. And here's some glossary on the strategies as well. So that's all available here under the My Account. We also have videos available. So it's a educational and tutorial videos available within ThetaTrader. These are like 2-3 minutes each usually. And if you need a little bit of help with ThetaTrader, it's all there, but quite frankly, it's so intuitive and easy to use. Now let me show you, let me magnify this here. If you want to look at your closed positions, you simply go to the tab here for closed positions. And you can sort in any way you'd like. We'll just leave it kind of default here. You'll see this demo account, the total of 20 trades, 13 short positions, 7 long positions. And this is kind of instructive, I think. 12 of the 13 short spreads were winners. And only 1 of the 6 long spreads were winners. And it was a big one. And that's kind of typical of when you buy options, right? That asymmetric return. But your probability of profit really isn't that high when you're just focusing on buying options, which is why we focus on selling options. And actually, this one big profit was in gold, and I'll show you that in a second. Yeah, you can see it here. We had a trade alert on some gold and just hit that one right here the last couple of months. But this is just a demo account, so don't make any judgments on the demo account based on performance. This is just to show you how it looks. If you want to go back in time, look on any one trade, you just click on it. So here, selling these 6 put spreads here. And this is what this trade looked like. The market was trading here. You sold this out of the money put spread, and you see it just kind of chopped around. Eventually enough theta decay happened, and you had a blue RTI with 10 days remaining. You got out of the trade. So that's simply how that works. That's how your closed positions work. And then you can also look on your dashboard, of course, for your open positions. You can also see them on this one big page as well. And I'll show you here, just to briefly mention gold. We'll talk a little bit about gold, but it's kind of the global macro environment really and landscape that we'll talk about. But you'll notice Under the bullish tab, there's gold. So there are gold call spreads available. If you want some long-term gold positions here to maintain a bit of a bullish posture, you can do that with ThetaTrader. We've kind of had that on there for a while now. We've had some interest in gold as it made record highs a couple months ago. And here's what it looks like on the graph. You see the record highs, we pull back. Now here's this trade, buy the 28.10, sell the 28.60. And here's the cost on that, just over $1,000. We'll place that here. We'll do 2 of these here. How about that? So anyway, just wanted to show you that that's available too. It might help to have a little bit of a kind of an absolute return asset class in your trading account. Now, let me show you these trade alerts. This is really exciting stuff. So you'll see here, we'll view this one alert. We'll click view. So this was from today. So if you were a client, you'd log into your dashboard and you would see the alert, and you'd also see it on your text message and also via email. But this is what this particular alert looks like. It's a January week 4 S&P 500 Dragonfly, has 51 days till expiration. You can see the calls here and the puts on this Dragonfly. See the current market price here. And the quantity is pre-selected for you and your account. Every trade you receive is custom to your account. And you can see it's set to 8, or you can lower it if you'd liked, but you cannot increase the risk or exposure. You can lower the exposure. Here's the entry price. You're trying to collect that much premium there. We'll go ahead and just accept this quantity. And that's as simple as that. And we'll look at the other one. Go back to the dashboard. We have one more to accept, and this is on the Russell 2000. It's also a Dragonfly. So here's what that graph looks like. 58 days till expiration. And again, this if you received it in your account, the quantity and the trade would be customized to you and your account. So you would not receive trades that are redundant or overlapping with existing positions. So there's a quantity of 16. We'll go ahead and accept that order. And there you go. All right, folks. So now you have a overview here of the ThetaTrader dashboard, but let me show you what is really great about the trade alerts. And I'm going to have to switch screens, so give me just a second. And I do see the chat filling up, so that's good. Keep it up, folks. I will probably answer some of the questions along the way, but keep them coming. So the trade alerts we just talked to you about, people really like to use them because they come right to them in their hand. They're holding their, you're near your cell phone almost all the time. So these are one-touch responsive alerts. You simply touch accept or reject, and these are integrated with your AltaVest trading account. All these alerts, all you do is touch accept to place the order. So here's an example. You'll get a text message with a link. Oops, there we go. And then you'll simply touch that link. It'll take you right to the alert. So you'll get a graph of the alert. This happens to be an iron condor. I need to update this, but you'll see the premium collected, cash required, quantity is pre-selected for you. And everything in terms of the risk and the reward of the trade is described in that position there. 71 days till expiration, targeted annualized return. And then you just touch accept. And then that's it. Then ThetaTrader will process and place that order for you. And it's just that simple. So people love those alerts, and I think you would too. So here's how to get started with a ThetaTrader membership. You would get everything we just saw, everything just reviewed. The ThetaTrader software includes the Theta trades, the RTI or the risk thermal indicators that automates your risk and profit taking, and then the trade simulator, that back testing or time machine. So all that valued at over $3,500. And then you have the alerts. The trade alerts also are part of your ThetaTrader membership, of course. Remember, trades are unique to you and your account, and they're tailored for you with the quantity and the sizing. They're pre-sized for you. These alerts are integrated and live. You just touch accept or reject, and that's all you have to do. And then once the trades are filled, the RTI will automatically manage those positions valued at over $4,400. So again, ThetaTrader gets the software, the alerts, over $8,000. But here's what really makes it worthwhile. We get a lot of great feedback on coaching. So you get people who are licensed and experienced, live people to talk to you, set up a screen sharing session, talk about anything you want, have a co-pilot, a licensed trader, discuss your strategy, review your history, whatever it might be. That value, they're at least $7,500. I know people are spending, I've heard, up to $25,000 for training and mentors. So that's all included with ThetaTrader. The alerts, the software, the coaching, valued at over $15,500. And I'm going to sound like one of those infomercials, but there is more. But I just don't want you to forget that we do offer the proprietary research that's only available to ThetaTrader members and unique to you, with the TradeScope and the daily trading commentary. And as well, you have the online video tutorials if you need them. They're all available in there. So to summarize ThetaTrader, everything we just talked about, valued at over $18,500, everything we just demonstrated. Of course, we're not going to offer it at $18,504 or even $39.97, which is, we used to offer it in live seminars, in-person seminars before the pandemic, actually. So we go city to city and do our presentations, and people loved meeting us, and we love meeting them in person. But everything seems to be online these days, and that's okay too. So we're going to do much better for you. And this is absolutely our lowest price ever. The MAD discount price is only $497. There is the link, cf.altivest.com/MAD. It's just the one page there, simple page. That's my direct phone number and email if you had any comments or questions. But take a screenshot of this and it'll be in the chat as well, I believe. We'll get that in there. Now, here's the thing too. If you want a rebate on that membership, you open your account with us and you fund it within 30 days with a minimum of $20,000, and you'll get a 50% rebate on that membership fee. So people like the rebates, so we've done that for a while now. And then here's how you get a free membership: $100,000 or more in your account, and we'll rebate that fully. So if you're going to trade with us and use ThetaTrader, and you meet those requirements, then you can get a rebate of some kind, if not a full 100% rebate. So how about some FAQs? Tax efficiency, I'll go through this quickly, but yes, you're trading in a tax efficient space when you're trading futures and futures options. And that essentially means if you're comparing what we do to trading on individual stocks, you have a much, really large tax benefit because of the way taxes are treated. 60% of the gains are taxed at the lower capital gains rate. So that obviously is a benefit. And no more itemizing each trade. Your 1099 is what you receive with your P&L. So always consult your tax attorney or advisor. IRA, yes. So contact us for details. We have IRAs transferring in every week to us. And why the E-minis? Well, they're liquid, they're efficient, and they're cost effective. The largest market share of densely packed strikes, 100 annual expirations, and granularity and coverage. So that offers superior execution according to the CME group. Cost savings of $4 to $15 per contract compared to SPX options. So they're looking at the tight bid offer spread. So they have a wide array of maturities and that deep liquidity. So, and that helps ThetaTrader because if we have the strikes available, the algorithm is looking for strikes that it needs. So it's going to find the calls here and the puts here. Then as time goes by, it'll find another set of calls and puts. And as more time goes by, so on and so forth. If you don't have a liquid market, then the algorithm searching, it won't be able to find what it needs. And then also with the dragonflies, remember, this is a six-legged trade, but it trades at one price as one trade when you trade it with us at using ThetaTrader. So one order placed at one trade at one price. You don't leg in. And if you do this with stocks, you're going to have to break it up. I've tried it. I've looked at like 5 or 6 major platforms. I don't see any of them doing six-legged spreads. So that's the big benefit too of using ThetaTrader and those E-mini options. These are sophisticated option strategies compared to the retail stock options trader. This woman here says most retail investors only have access to basic call and put options. They don't have access to option spreads or more sophisticated strategies. So remember, if you're only buying options, Theta is against you. And again, she mentions here that's a popular trading strategy, but it is risky. The appeal is for retail investors to only buy options because they're much cheaper, but your potential for profit is actually not that high. In 2021, 11% of Robinhood active users made an options trade, and of that, fewer than 1% actually made a multi-leg options trade. So that's kind of the point of ThetaTrader. We like to really use and harness that premium collection and not focus on just buying options. More advantages on the E-minis. Why not just follow a few markets rather than thousands? Efficient margin, clear cost structure. There's no payment for order flow. These are not securities options, so there's no payment for order flow, like I said. They all trade at the Globex exchange, electronic exchange at the CME group. So every order is treated equally. Commissions, you saw them, but it's 5.25 round turn all in. And this is from earlier this year, a big box brokerage firm, and they have their listing at 2.25, but that's per side. And then they add more fees on top, like clearing and exchange fees, and it ends up being higher than what we charge. So our rates are definitely competitive in our space. People ask about performance. Well, performance is different depending on every person. Everyone uses it differently. ThetaTrader is for self-directed accounts. Everyone makes their own decisions. And as a reminder, all the calculations are net. And again, any kind of a trading account you would have at any brokerage firm is the same kind of thing you'd have here. And how about I run through a quick 10-minute, not even that, how about 5 minutes, and we'll get to some questions. But I just want to jump in about gold because it kind of, we have it in there in ThetaTrader. If you want to have access to some gold spreads, you can. But this is interesting. Alan Greenspan, just over a year ago, if gold is a relic of history, why do central banks and the IMF still hold over 1 trillion of gold? And that's when gold was over only 1,800. So it got up to 2,900. So gold's relative performance, it kind of slips past us, but this is back to 2005. Gold is a gold line here. So gold is up 6.5 times since October of 2004 compared to the S&P 500 up 5.3 times. So very sneaky because it just doesn't get a lot of headlines. Not always sexy. But anyway, I bet you probably weren't aware of that. Key factors in the bull market here, ETF, US budget deficits, monetary policy relates to inflation, foreign central bank ownership, and then the BRICS. We'll just touch on a couple of these. Investor demand for gold has come from Asia, not the West. Central banks are buying ETFs, but retail has been selling them. So you can see the black line is ETFs, and that's retail. The retail market is selling ETFs, but meanwhile the gold price is zooming. So who's buying the gold? Well, not the Americans, according to Jim Rickards. So federal spending and the Fed, 1.4 trillion in interest payments, 28% of government revenue. So we'll talk just in a second. I'll show you a little bit more about that, but that's pretty astounding. That's kind of like back to World War II levels. But inflation, look at this here. US dollar has fallen, well, 99% in value. Hard to believe. But But I guess when you look at these price increases here, that's pretty stunning actually to see this graph. That's why I always scratch my head like, wow, that sandwich didn't used to be that much just a year ago. So the US dollar is down 99% since 1971. But gold is up 78 times since that same period of time. And this is interesting. Here's the headline rate of inflation. This red line here, the CPI, and the blue line is what they call the shadow stat for inflation or alternative inflation. And then the gold line is the price of gold. So gold seems to be following this alternative inflation metric here more so than the headline. So real inflation is understated. And look at this. Here's the actual inflation rate here compared to what it would look like if it was still 2% a year, meeting the Fed target. So we're way above target. Paul Tudor Jones, one of the best money managers, he says all roads lead to inflation, and that's why he's long gold. U.S. Treasury Secretary pick. His largest position is gold, his biggest position. So that was interesting. So anyway, it's a hedge against unexpected inflation or even expected inflation. The October CPI shows signs that disinflation trend might be fading. So here's some projections for this CPI coming out here soon, continuing to actually make a bottom and then move higher, turning upwards. And I don't know if this will happen, but here's where we are now, the blue. The red line is where we were in the 70s. So I don't know if we're going to follow that path, but that would be pretty nasty if we were. And then foreign central banks, they're the ones selling treasuries, 60 billion, 50 billion from China and Japan. And what are they doing with that money? Well, treasury ownership is down, but gold reserves have doubled. That's what it looks like here on the graph. And then here we are in Market Watch. They talk to us periodically. We talked about out of control federal spending, debasing of the US dollar, even though foreign demand remains strong. I don't know if the Doge team with Elon Musk will be able to cut back enough to make a difference, but it's possible. His message of austerity, we shall see. But that could be a legitimate effort to reduce government spending and the deficit. But needless to say, foreign central bank gold demand remains the most important bullish driver for gold. So anyway, that's enough of that. Just wanted to kind of run that over the audience here. The BRICS are getting to a non-dollar payment system as well, and establishing a precious metals exchange. So anyway, we like ThetaTrader. We think you'd like it too. We touched on all these different points, all the different strategies available. This is kind of a mess. We try not to get into day trading. Most of these trades are longer term, or I should say maybe 60 days, maybe 10 days. You got that wide margin of error between your strikes when you're selling these dragons. We don't want you sitting in front of a screen 10 to 12 hours a day. We think it's important to diversify. You know, NASDAQ dropped 80% in the dot-com bubble, and then it took about 15 years to recover. So we don't want to end up in a period like that where you just kind of buy and hold something. Here's some drawdowns over time in history. They can sometimes last decades, and if you buy at the wrong time and just sit there, I think the prior presenter even mentioned drawdowns as well. You need to try to avoid those drawdowns. So anyway, we like the alternative approach that ThetaTrader offers you, especially with these trade alerts, make it so convenient. You'll see here on the dashboard what we saw earlier. Here's what it looks like on your smart device. You just touch accept, and here's the deal again. That's the mad price. You sign up and we'll get you onboarded. And let's see if I can get to a few questions here. These algo-driven options trades. I think it does help control your emotions, by the way, and strategies for any market condition. Don't forget the trade simulator. Don't need to go spend much time on these. We saw the demo. Okay, so that's that. And let me see if I have any comments here. Wow, tsunami warning. Interesting. The margin is the cash required is the maximum risk on the trade, so you won't have a margin call. Good question. And shorter time frame trades, it just depends on the volatility and some of the other elements, but sometimes you get into a trade and it can be out in a couple days, and other times we have done some shorter dated stuff. Yeah, it's available. Put risk and versus call risk. Well, your put risk and your call risk is going to be defined by the difference between the two strikes. People are asking about software with a brokerage. We are the brokerage firm. AltaVest is the brokerage firm, and ThetaTrader is our technology that we developed for our clients. Okay. And someone asked about the blue occur. Well, you'll get those blue signals to take profits, and it just depends on the secret sauce underneath the algorithm. And the orders are filled or placed as a spread, and they are filled as a spread, as one price, as one order. And the E-minis have all the volume and liquidity that we need. And let's see here. Someone's asking about the profit, potential profit. Call me about some of those more in-depth questions. I probably don't have time to get into all that. But good question. Please keep them coming. And again, we are the brokerage firm. And yes, you can trade with an IRA. We work with Midland Trust. Yep, someone mentioned Hedgeye. We do track Hedgeye research. And that one slide I showed was public information, so I'm not spreading information I shouldn't be spreading, just so you know. Good question. And yes, you can adjust. You can do trade adjustments. Good question. It can close the trades for you. Yes, when the blue RTI and or the red RTI is hit, whichever happens first, the trade will be closed automatically. That's correct. And let's see whatever else. Someone asked about FDIC. Well, we're not a bank, so we're regulated with the CFTC and the NFA. We've been doing this for since 1997. And yes, if you're in the UK, you can use it. So I don't know. I think am I out of time, John and Kate, or I think I am.
Yeah, that's about right. And our tsunami warning in San Francisco has been called off. So I think in Orange County you're safe.
Well, good. There was a surf competition this morning. My daughter was in, so
Wow, must have
she's
been one heck of a competition with
yeah.
tidal waves coming in.
All right. Well, thank you for having me, everyone. And I think I'll wrap it up and leave the rest to John. But you've got our offer, and we'd love to have you join us. And I'm available for any questions. Thank you.